Welcome, everyone. My name's Jim Jeffries, Chairman of the M&A Leadership Council, and we are about to present to you another in a series of webinars that are held by BDO and jointly by the M&A Leadership Council. BDO happens to be our exclusive presenters in the art of M&A due diligence and participate in many of the training sessions that we do across the country. And across the world, we've now trained over 3,000 executives in the art of M&A. And today we've got one of the hot topics for those of us who live in the M&A environment, and that one happens to be carve-outs. Carve-outs today are easily stated as the most difficult of divestments for companies today. They're a huge challenge, yet our research is showing that roughly 30% of all M&A deals today are divestitures. So divestments are becoming a very important part of M&A. They're part of this new idea of managing an enterprise as a portfolio. So today we want to learn about divestitures, and we have a great person here to help us with that. Divestments being the hardest of all of the, carve-outs being the hardest of all kinds of divestitures. I want to introduce to you Tony Enlow, who will be our presenter today. He's a partner with BDO. Tony is also a certified M&A specialist in the area of due diligence and financial transactions. And Tony will be presenting this. I want to also state that Tony is a new member of the Board of M&A Standards, an exclusive organization that oversees certification programs as well as other training environments. So, Tony, congratulations on your new appointment to the Board of M&A Standards. Let's get started and hear your story.
Thank you, Jim. Welcome, everyone. When you are contemplating the acquisition of a carved-out entity, you need to realize up front that carve-out transactions are the riskiest, most complex transactions with a very high failure rate, i.e. they fail to add value to the acquiring entity. The key here to any carve-out transaction is to know what you're buying. How does it operate today? How connected to the parent company is it? Are there services or infrastructure that you are going to need post-close for an interim period? If so, what does a transition services agreement look like? How much will these services or infrastructure cost that you're going to need? How long will you need these services to last? And these are all questions that you have to think about when you're looking at a carve-out transaction. And that's why diligence around a carve-out takes some special care. It seems obvious, but let's just think about what a carve-out is for a second. It's basically anything that involves less than an entire consolidated entity. That's can be a number of things. It can be mostly standalone subsidiaries with its own infrastructure, to assets or a combination of assets with virtually no infrastructure. So the further down the list you're seeing here that you go, the more difficult the analysis becomes, and really the more important the diligence efforts become as well.
Tony, I'm sorry to interrupt, but I have thought for a long time when I first got into the M&A arena that carve-outs and divestitures were the same thing. But there really is a big core difference between selling off an entity that's part of the portfolio of a business and actually carving out and creating, as it were, an entity that is so strongly connected to the mothership. And I think when you think about all the processes and all the connectivity, all the dependency that a business that you're trying to carve out has, that's really what makes it so very difficult.
That's exactly right. So, for instance, just going further with your example, if you were buying a simple product line from another company, what if they have shared facilities? Maybe they share production equipment, people, infrastructure, what other products are they producing on the same machinery that they're producing yours on? Do you need to buy new machinery post-transaction, or will you lease time on their facilities and their machinery? What we see here a lot, that there's probably no full income statement or balance sheet the further down this list you go. As a result, the working capital can be very difficult to assess. If they have commingled accounts receivable, accounts payable, commingled inventory, things like that. And so the conclusion here is that it really requires a lot of analysis to understand the issues to make the transaction a success.
No question, absolutely.
So let's turn to some of the specific challenges that you might have in a carve-out transaction. One we see a lot here is the parent company may limit access to standalone financial statements. The parent is a lot of times reluctant to show their full P&Ls and balance sheets, and so they may only share with you selected pieces of information. What that does is it really limits your ability to understand the intercompany or related party transactions, to understand the connectivity to the parent, especially what the related potential TSA, transition services agreement requirements might be. An analysis of customers, accounts receivable, accounts payable, inventory, any accrued liabilities, even fixed assets sometimes are commingled. They're not separated out. So there's a much deeper dive into these areas to understand what it is you're getting, and from a working capital perspective, are you going to have enough cash post-close to operate the business? Do you even know what that is? And then lastly, as a result of this, the determination of the parent company's purchasing leverage is difficult to assess. What kind of buying power do they have, and will that continue going forward? Will you lose that buying power as part of the transaction? Does that create a value erosion for you post-transaction? Are you going to factor that into your valuation? And so this is one of the key areas that we think of, that you guys have to think about when you're looking at a carve-out. There's other challenges here too. As we talked about, in the product line case, historical financials may not exist, or they may have just pieces of it. They may know revenue, but they don't know anything else. We also discussed that the carve-out entity may lack infrastructure. What that means is the integration could take longer and it could cost more. The transaction costs on a carve-out are typically higher because more time is devoted to diligence around TSA-related items, infrastructure, really understanding what it is that they have, what it is you're buying, and what are you going to need post-close. And then lastly, the organizational disruption is really high. The potential is really high when you're buying a carve-out. Think about things like missing critical infrastructure post-close. If you can't bill your customers, or if you can't collect from your customers, or you can't take orders, for instance, because you don't have a critical infrastructure item that you need to be able to take those orders. And so these are some really costly and issues that you really have to spend a lot of time trying to understand. Right, and there are some other key considerations to think about when you're doing a carve-out. And what about shared personnel? For example, if the target uses somebody only 10% of the time, but you have to hire somebody 100% of the time to do that, the work that they were doing. So we call that a dyssynergy. Maybe you don't have the capacity within your own organization to assume those responsibilities. Intercompany transactions may become relevant now. The parent may become a vendor or a customer. Will the terms of those transactions change? Will the profit margins change? How does that impact your valuation? And then integration planning becomes more critical and time sensitive, because there's opposing positions from a transition services agreement. You, the buyer of a carve-out, would like the longest possible transition services agreement to be able to put your infrastructure in place. The seller, they want to cut the cord much more quickly, and so you may have to accelerate your integration faster than you normally would.
Tony, I think of two of these bullet points that we just went over. I think the personnel issue is very, very critical because people on that are being carved out, if that's a proper term, feel discarded by the company that's selling off that portion of the business, and they oftentimes don't realize that they're being attracted to another organization. And we like to talk oftentimes in our sessions that to be sold by a company is not to feel so bad because you are desired and you're wanted by the buyer. So I think that's absolutely one of the things that occurs here. And of course, it is very disruptive. The other thing is that the integration planning piece obviously is very, very sensitive and very critical. And the transition service, the TSA as we call it, is, like you say, the seller wants to shed the responsibility of supporting the acquired carve-out as fast as possible, and the company being carved out wants the support of the seller as long as possible, and even to the point of paying penalties at times to extend their dependency on the selling organization. So two very different but the same kind of challenges that you have.
Absolutely. And so, that's a nice transition to this next slide here. Think about the key infrastructure that you're getting from the seller or the parent company, and compare that to what you'll actually need post-closing. All of these potentially feed into a transition services agreement, or might be required to be filled by you, the buyer, if not included in the transition services agreement. So maybe you have to put in your own information technology ahead of the post-close rather quickly, or even day one. And so the closing could take longer while you get your infrastructure in place. Think about key management, for instance. They all work for the parent company, and there's going to be a management vacuum at the end of the day that these guys may not be going with the deal. What about the tax attributes? Maybe they change as a result of the transaction, or they just go away. And so you need to factor those in as well to your evaluation. And so we talked about TSA a lot, but it's basically it's one of the important documents as part of doing a carved-out transaction. And it's only as good as the diligence effort preceding the transition services agreement. What does it do? Well, one, it bridges the gap between what's missing and what you guys have identified and is what you need post-close. And as we've talked about earlier, the goal of due diligence really is to provide enough information to properly identify what is missing, and have a realistic time frame for you, the buyer, to institute your own infrastructure. And so let's talk about some of the key focus areas when you're looking at a carve-out transaction. One, you really want to understand, if all of the costs are reflected in the carved-out entity that you're buying. Number two, are there costs being allocated with no benefit that are included in there? And conversely, if they're not allocating costs that maybe they are receiving a benefit for, what that means is you might have a cost going forward, and then will there be lost benefits as a result of the transaction? For instance, purchasing power and things like that. And the way I look at costs, I look at it in basically three categories. You've got the direct costs, which are actual costs of the entity itself, plus the actual costs incurred by the parent company, but charged directly to the entity. So maybe the parent company incurred some legal costs and charged those actual costs to the entity. And then there's the indirect costs. These are allocated costs using some methodology, percentage of sales, percentage of square feet, etc. And then there's the unallocated costs. These costs are basically the costs incurred by the parent on behalf of the entity, but not allocated to the entity. These could be items like payroll processing or property tax expense or a number of other expenses that may or may not be allocating to the entity, but the entity is benefiting from it, and you, the buyer, post-close, will incur those costs. So you want to understand, if there's any unallocated costs that they're incurring at the parent company. And it's really important to understand, on the indirect costs, what that allocation methodology is. One of the starting points for a TSA or the diligence process around missing infrastructure or what services they're getting from the parent is really what they're being allocated. And so that allocation detail is really your starting point for the possible TSA items that you want to think about. And I can't emphasize enough, the importance of focusing on infrastructure here from a carve-out perspective, which includes the shared service functions. If a failure occurs in a carve-out transaction, it typically occurs and comes down to the miss on a shared services or a critical infrastructure item. And I'll repeat this again because it's very important. You want to understand, what do they have today, and what are you going to need after the completed transaction?
And isn't that why, a deeper due diligence is relevant here, required, if you will? Access to knowing exactly before you go closing on something like this. It would seem to me, Tony, that there needs to be a much deeper diligence, much more access, visualization, as well as what is provided through documentation before you go forward, because a lot of this critical infrastructure and other things can become big surprises later on.
Absolutely. You're really going to dig deep in this slide here. It really talks about the shared service focus areas. It may not be all inclusive, but you're really going to go into, who does their accounting, what are their accounting processes, what are their cash management, treasury functions. I mean, you're going to walk through and do walkthroughs of all of their processes to understand how connected they are, and that takes a lot of time. The last thing you want is to be in a position where you can't deliver goods to your customer because your purchasing and logistics functions aren't functioning properly because you didn't analyze it post-close, and so there's a critical component that might be missing from that. And so you really, it all comes down to how connected the entity is with the parent, and then once those connections are identified, what can you take over as a buyer right away, day one, and then what are you going to need from the parent organization and for how long, and then set those prices accordingly. And so I'll give you two examples, and let me finish with these examples. The first example we've seen a number of times in a carve-out where the parent company basically subsidize its healthcare costs of the business unit that's being carved out. They're self-insured for health insurance, and so the parent company will set the rates that they're charging all of their subsidiaries, that'll be their expense for the year. But the actual claims that come in are much, much higher than that expense when you compare what's going on at the subsidiary versus the parent company. And so this really can impact your value. So when you're looking at a carved out entity with self-insurance, you want to understand how are those claims being processed? Is the parent company taking on excess cost that they're not pushing down to the subsidiary? And then the last one, we've seen where the parent company will cherry pick the best of the management team of the entity that's being carved out, keep those people for their own organization, and not replace them, or replace them with somebody that's not as good, doesn't have the proper experience. And so what you'll be left with is a vacuum, a management vacuum, and not the right people running the organization.
That's great stuff, Tony. Listen, thanks a lot for what you've presented today, and I want to tell the audience that this is just the tip of the iceberg. Carve-outs and other areas dealing with due diligence, which is a key component of success, along the M&A lifeline and live stream is very, very critical. And the M&A Leadership Council is honored to have BDO. BDO is a powerful, up-and-coming global, not only accounting firm, but a professional service firm that can basically deal with all kinds of, and almost all certainly, issues that corporations today face. I'm inviting everybody that's listening to consider attending the Art of M&A Due Diligence coming up in a week or two, November 6th out in Scottsdale, Arizona, where you'll meet Tony and you'll meet the rest of the BDO folks out there as well as other members of the council. So we have a few seats left. The good news is this is going to easily be a sellout for us, but the bad news is for you, if you're not on the list and haven't registered, you need to do so. Please take a look at our website, get familiar with the council, our activities and our training. Again, Tony, thanks so much. Great job.
Thanks, Jim.